here. No? Ah, okay. No, I'm not the last one then. Sorry about that. I think we could. Okay, two more. Great. My name is Alexis Dawance. I'm working for 60 Asset Management, and I'm going to talk to you about a very controversial and contrarian trade ID today. 60 Asset Management is the asset manager of a small private bank in Geneva called Cité Gestion. It's a 15-year-old bank founded in 2009. We have a high tier 1 of 20.5. We have 125 employees and 10 billion AUM. China. Most of the investors I'm talking to today are extremely pissed off, I would say. They've lost a lot of money in China. Americans are telling me it's uninvestable. Most of the investors are trying to reduce as much as possible the exposure to this country. They are really afraid of the dictatorship today of Xi and his measures. They were not really afraid 3 years ago when Baba was doubling every year, but things have changed. As a whole, when we think there's a big opportunity, because at the end of the day, value investing is about being contrarian, and every dog has its price. So what we like in China today, first of all, we've seen a huge value destruction during the last 4 years. 7 trillion of market cap disappeared from the Chinese market. That includes A shares and H shares. So it's basically the size of France, UK, and Spain put together. What's interesting is the valuation is becoming really attractive on certain metric. If you look at Warren Buffett's favorite indicator, the market cap to GDP ratio, the US stands anywhere between 200 and 250 currently, which is quite expensive on a historical basis, whereas China is still around 50%. There's a huge gap today in PEs when you look at the Hang Seng and versus the S&P 500. You see the PE of the US market is really is quite expanded yet to reach around 25 times, while the Hang Seng is around 5-6 times. It rebounded slightly since I done that's this slide, but basically the last time we had such a wide spread was 2000. So, sorry. Yeah. It's actually a quite good diversifier for people who are looking at global equities. There's a very low correlation with the global markets, especially A shares. So the Chinese market can actually reduce risk through diversification as well. It's the lowest cost of capital. Today, interest rates are much lower in China than they are in the US. The 10-year in China is around 2.3%, while it's at 4.08 in the US. The last time we had a cheaper cost of capital in China than in the US was during the period of 2006-2007. And during that time, the MSCI China did very well compared to the US market. So we think that could be a situation where we could see this again. Plus, China has a lot of room to lower interest rates. And of course, as we all know, if you have the lower rates you have, the better it is for your DCF. We think there is no credit crisis. The real estate bubble is kind of behind us. We're probably at the end of that. A lot of debt, bad debt, has been written off. And what's interesting is when you look at the corporate credit spreads, they're not that wide. And I think that's really a sign of credit crisis. The second sign of credit crisis is the banks. The banks are trading quite well in China today. And one of the main problems in China is spending. If you look at the household, the dark blue line is basically the new deposit of household. Household have a lot of money and they have low debt, so the household new loans is quite low. It's the opposite of the US consumer. And the issue in China is that the consumer are not spending enough. So they need more confidence, but when they will start to spend, things will get better. And the consensus today, if you look at the Financial Times and The Economist, is that China is uninvestable. It's clearly underrepresented in the MSCI World Index. If you look at China, the world, it's the second economy of the world. It's 18% of the world's GDP. It's 36% of the global manufacturing capacity. It's 12% of the global market cap, even after this huge drop. And it's 2.3% of the MSCI All Country. It's 0.6% of the MSCI Developed Index. There are 4 companies in the US which are larger than China in the MSCI world. Microsoft, 4.1%. Apple, 3.7%. NVIDIA is larger than the whole China. I mean, NVIDIA, Amazon, and finally, if you looked on the chart below, the Chinese market, if you add HA and ADRs, it's approximately 14 trillion of market cap, while all the Magnificent Seven together, they're far away from that amount. So the Americans are doing the index. And that's the proof. Don't forget that today the USA is 70% of the developed MSCI World Index, and it's 65% of the MSCI World All Country Index. Japan, as a reminder, was 55% of the MSCI All Index in 1989. The global investors are significantly underweight Chinese equities. Most of the funds now have reduced significantly their exposure. And this might be interesting if we see a continuation of the inversion of the bottoming trend we've seen during the last couple of weeks. People might have to change their allocation, and that could bring tons of inflows in the country. Equities are actually discounting a slowdown, but the PMI, the real economy, is not as bad as the stock market. The Chinese equities are discounting a sharp deterioration of the PMI, as you can see. The blue line is going up. The PMI is strong, while equity market is extremely weak. So we see the investment opportunities in China also, as the government is really trying to push the market. And is coming with, I think the stock market is probably more important for today's government than it used to be. They're trying to come up with many different initiatives, and one of them was removing the stamp duty, another one was accepting 10 international banks to issue bonds, another one is to have the China team buying the market. They have 300 billion of fresh money. They've already spent 50 billion last week. So we're seeing a lot of initiatives, and this is, I think, bullish for the market. So what do we like in China? I think at this point of time, we think the risk reward in the Hang Seng Index is quite interesting. It was trading at the same level than 1999, and is extremely unloved. A shares, small and mid caps, are also quite interesting. We like the CSI 500 and also the CSI 1000. Those two sub-indices have collapsed. At one point, they were down 35% this year, last month. And we think it's interesting also that you can do the repo monetization on those two indices is also an opportunity, but that's something we can discuss later. And finally, there is one single stock that we like. I mean, it's not the only one, but I'm going to do a little survey. So it's a stock that's trading at approximately 1x sales. 5 times EV/EBIT, 16 times free cash flow yield, and a P of 9. So, in which sector is this company? Is it a utility, consumer staple, or internet/AI? Internet/AI. So yes, there is some internet and value. I mean, value and AI are actually not completely the opposite, as we can see. So probably many of you have heard of Baidu, but don't really follow it, as historically it was not a value stock. What's inside Baidu today? I mean, Baidu, in the logo you have the paw of a dog. The animal is known for its excellent search capabilities, helping you to find what you need. So it's basically a search engine. Some people say it's the Google of China. I would say it's not as good as Google, but it's a search, and it's the most widely used search engine in China. The search engine within Baidu is really a cash cow. It represents 85% of its revenue, and it has a slow growth. This year it grew at 6%, so it's kind of mature growth with decent margin. But the reason we like Baidu today is because of AI. AI and the cloud, this is the opportunity. It's 15% of sales today, and it's high margin and potentially huge potential, especially when you think about most of the AI stocks. I mean, if you look at a company like ARM, who's manufacturing chip for mobile phone, ARM today is worth 150 billion. They have 2 billion in sales, or 3 billion maybe next year. Here we have a company that's trading. Baidu has a market cap of 36 billion and has 24 billion EV, as it has a lot of net cash. So what do? You have the search and online. This is the cash cow, the search engine. They have a mapping service called Baidu Maps. They have kind of Wikipedia, which is called Baidu Baike. They have the discussion forum called Tieba. They own 56% of the publicly listed company IQ. IQIYI is basically the market-leading online streaming platform in China and Asia. It's basically the Chinese Netflix. And on the AI side, they have Wangpan, which is the cloud storage service. They have the Ernie bot that you probably have heard of, which is the competitor of, this is a Chinese ChatGPT. You have Comate, which is a next generation coding tool powered by Ernie, which help programmers programming. You have Apollo Go, which is a robotaxi service. It's an autonomous driving car. And frankly, if you go on YouTube, you can see the experience of someone calling the robot, the car arrives, types the code, get inside, no driver. They are active in 20 cities. They've already done 840,000 rides. So it's there actually, and that's quite interesting to see that we are not allowing robotaxi yet on our roads, but it's live in China. So Baidu on the search side, it is the most popular search engine. They have 677 million monthly active users, 6 billion daily search. The app has been downloaded, they have 200 million approximately active users, and advertising sits at the core of their search business. So it's basically like Google AdWords. SMEs are paying ads to get more clients. What's interesting also is that Baidu has AI. They've also added AI to the search component, but really on the ad side. So basically, if you go on the website of Baidu and you are a small shop in China, now they give you the opportunity to create your whole advertising campaign. You can choose AI-generated model, you can choose AI-generated places, pictures, movie. So you basically don't have to create your advertising campaign. They can make it for you on a very easy way, couple of steps. very intuitive. So it's very easy for a little shop to create a very nice ad on a very easy way using AI. What is ERNIE? ERNIE stands for Enhanced Representation from Knowledge Integration. It's the first domestic AI app to be fully available in China, so they have a first mover advantage. Tencent and Alibaba are also developing their own boats, but Baidu has the first moving advantage. They are basically, in theory, it's a large LLM than ChatGPT-4 because they have 260 billion parameters compared to 100 billion for ChatGPT-4. ERNIE's bot is currently the most downloaded free app in China, and it also has surpassed 100 million users. Baidu's CEO, Robin Li, believes that ERNIE's bot outperforms OpenAI in Chinese language. Of course, it's lagging in English. Robin Li owns 20% of the stock, by the way. We were talking about managers and alignment of interest. I think this is interesting. ERNIE bot doesn't require the most powerful chip. And the company launched in November a paid version of ERNIE. Finally, what's interesting is that Lenovo and Samsung and Honor, they added the AI assistant in their phone. So the Galaxy S24 has AI and has Baidu by default in their phone. Lenovo laptop have that by default in China. And I think this is also interesting that those companies are trusting Baidu's AI. As of December, 26,000 companies in China are using the bot. What's interesting is Robin Li wants to monetize AI and wants to attract more developers to create apps based on their AI. For example, this is a conference, Create the Future, next month in Shenzhen, where they're bringing all those developers to build apps based on their AI, because that's an interesting way for them to have as many apps built on all the whole ecosystems, and for each query, they will get paid and receive money. So I think it's a potential interesting development. If you compare ChatGPT to ERNIE, ChatGPT's got 180 million registered users, ERNIE 100. ChatGPT's got 1.6 billion visits. ERNIE, I don't know, I couldn't find the data. On terms of revenues, in 2023, $200 million for ChatGPT, 91 million for ERNIE. What's interesting is the enterprise value. ChatGPT, if you look at the last round, OpenAI valued at 80 billion after the last deal. And current ERNIE's valuation in Baidu's valuation, 0. Investors do not really value AI in the Baidu stocks today when you look at the multiples. And finally, we look at the price per month. The paid version of ChatGPT is at $20, while ERNIE is 59 yuan, which is approximately $8. So the stock price. We've seen some negative news flow recently. They had to cancel the Joy acquisition. Joy is like a little TikTok in China. They had rumors of sanction risk from the US because of military link. They came out and denied completely the link with the military, but nevertheless, the stock was down quite a lot. And they also had slightly lower profit due to a lot of AI spending, and that's going to be probably the case in 2024 because they're investing a lot in AI. But nevertheless, the results were good on Q4 23. So what's interesting is when you look at the stock, you see this steady growth, and you see from the last 4 years, the growth hasn't been, the yellow lines are the sales, the gray line is the enterprise value, the green line is the stock price. So you see you see kind of a mature business in the search. You don't see the AI impact yet. But what's interesting is the stock today has an EV of 24 billion market cap. I mean, this is tiny. When you compare to AI champions in the US, NVIDIA's 2.4 trillion, Microsoft 3 trillion. I mean, you talk trillion, here you're like 20 billion. It's like for someone who's got 670 million users on a daily basis. And what's interesting is you're paying the same valuation than 2010. But the company at the time had like maybe, not even 1 billion in sales. So the stock is not trading like an AI stock, as you can see. It's not even trading like a tech stock, barely like an advertising company. Not even actually. If you look at Publicis, it's probably trading at a higher multiple than Baidu. So why the stock is so cheap? First, for 90% of people who have been doubling down on Baba, losing money, throwing the towels, China is uninvestable. Number two is sanction lists. I mean, US will put Baidu on the sanction list. Sanction is something that might happen, but I think people fear the kind of a Russian type of sanction in China. I think if sanctions arrive, I mean, there are already many stocks which are under sanction in China, in the US. China Mobile, China Telecom, those stocks are under sanction. US investors cannot buy those. So if we see sanction in China, it's going to be not as abrupt as the Russian. So it's not like you would lose completely your investment. You would have some time to divest, like we've seen in the past. The poor China macro, I mean, some people fear for the lower advertising revenues. VIE entity Cayman structure, as the company is listed in the US, but it's also now listed in Hong Kong. So if you want to maybe take less risk, you can buy the Hong Kong Baidu listing. There are some people who think that AI will kill search. It's possible. Maybe you no longer use a search engine if you do everything through AI. But the good thing is, actually, Baidu is doing both. So if that's the case, they might benefit from AI. And then some people are just fearing stronger competition around the driving market, about the cloud, and also that search. You see super apps such as WeChat or Taobao or ByteDance might reduce the will of people going on a search engine because you have the search functionality within those super apps. The catalyst for us is, I think there's a big shift happening in China. Last week, Xi said to address the problem of debt in the regions that he will stop funding infrastructure projects in the east and in highly indebted regions. So what he wants to do, he wants to focus on tech. So basically the message for 1 week is less infrastructure, less white elephants, more tech. And guess which company he went visited yesterday and during the night? She went to visit Baidu. So I don't know if that's going to have an impact, but nevertheless, he went to visit Baidu and a semiconductor production company. But it probably shows the will of China to move on and to change its model, traditional model, which has been building infrastructure. Baidu achieved a breakthrough in monetization of AI chatbot, as we mentioned. The paid version has been working so far, and they managed to have 91 million sales in the last quarter. And Robin Lee believes that AI-related service will generate several billion yuan in incremental sales this year. So he's quite bullish. I don't know if he's right, but that's the optionality. And I think in Baidu is really this optionality of AI. It's very difficult to assess if AI will work, will not work, is it a fad, is it something, but here there is big optionality and you can capture that as a very low price and a good risk reward. Finally, what was encouraging during last quarter was the 17% year-on-year growth on operating income, 18% year-on-year growth on free cash flow. They exceeded expectations overall. And also, they're doing a share buyback. They've bought back 669 million in 2023. So we like the Gen AI contribution, the better than expected margin, and the accelerated share buyback. So valuation, how much does that worth? When we look at the sum of the part, we think that the current price is $100. We think it could have 75% upside on the sum of the part, and worth $175. I mean, search and feed, we value it at approximately 20 billion, which is $55 per share. We value it at 6 times P, based on mature peer average. Apollo, which is the robotaxi, we value it as a discount to Pony and Waymo. Waymo, the leader in robotaxis, is worth 30 billion, Pony 5. Apollo is a bit in between. AI Cloud, we put a 3.5 times price to sales, similar to peers. IQ is a publicly listed company, so we take the market price, we add an 8% investment discount. They own 56% of IQ, so that's a 2 billion. Finally, they have 20 billion in net cash. And I think that's very important because AI, you need cash. You need to be able to invest. And I think they have a lot of dry powder. And finally, they own 9% of Trip.com. That share is valued at $2.3 billion, and we apply 8% discount. So we end up with a valuation of 62 billion, which translates of a stock of 175. These are the comps we've been using for analysis. If you look at the PE, I mean, just by doing some slight increase in PEs for this year, for next year, we're talking 10%, not a tremendous growth. And by just putting a 15 times on that, you can easily reach $200. And what's interesting is that if those income materialize from AI, I think the PE could be much higher. So you could have kind of a double effect, higher margins, higher PE. So, and what's interesting, I just found yesterday, I mean, a couple of days ago, by coincidence, Citron Research, which is, it's more a shorter historically than an investor, but he came up with a few tweets that I found, and he was saying Baidu should trade at 210. It remains the most underappreciated name in AI. Despite being the clear leader in AI in China, their stock is trading at historically low multiple. The China slump will end. Citron recommends investors to look at the work of Frame from Benchmark, blah, blah, blah. But it's, so it's quite interesting. And there's also another one which is quite bullish. So basically the current P X cash, you're at like 5.5 times. And the trailing is at 12. Next year's 24 is around 10. But you see the EV is very low. So in conclusion, Baidu stocks trading near 1-year lows despite beating Q4 expectation. They have a large net cash position, strong growth in operation income, free cash flow. The integration of AI chatbot Ernie into search is driving a conversion rate. And finally, we think on the price to free cash flow ratio, it's a very undervalued stock. And finally, when you look at what they have invested in R&D, they've invested 19 billion in R&D for the last 10 years, which is approximately their enterprise value today. And just to end, I've just asked the question to Copilot. So I've asked AI on AI, what AI was thinking about the other AI. And my question was, is Baidu successful in China? And the Microsoft Copilot answers said, Baidu, referred as the Google of China, is indeed a remarkably successful technology company on its home country. So they have a market dominance. Baidu holds over 70% of the search engine market in China, making it the leading search engine in the country. Founder and vision, founded by Robin Lee in 2000, Baidu has thrived under his leadership, despite facing censorship and strict government regulations. Revenue generation, Baidu's successful monetization strategies includes advertising, online marketing. And then technological innovation, Baidu's pioneering breakthrough in artificial intelligence and beyond. So in summary, Baidu's impressive market share, revenue models, and commitment have made it a powerhouse in China's tech landscape. That's funny because that's what the Americans are saying, not the Chinese. So we have a China product at 60 Asset Management. Our strategy has delivered a 24% return since 2021 in a very difficult market. We've been outperforming the MSCI China, which is down 49% during the same period, with a lower volatility and a lower drawdown. So I'm here if you have questions. Not many interest in Chinese stocks. Hundreds. There are currently hundreds of LLM startups in China. But I would say the two main competitors I mentioned before is Alibaba and Tencent. They're spending a lot. They want to catch up with Baidu. So are they equals, or is Baidu like far? I've seen the result. There is a league table with the different bots, and frankly, the gap is narrowing. So Tencent and Alibaba are really catching up with Baidu. Baidu is still number one, but I see an oligopoly probably in 1 year time. But I think you still need a lot of money, and it's not that easy. So I think most of the smaller initiatives will probably not compete.
Thank you, and I agree with you. I mean, this is the China equity is sort of like investing in a bank in March of '09 right now. So it's deep despair. Thank you very much.
Thank you. Anybody else?
One more question here.
So my question is, when you compare Baidu to other Chinese companies, let's say... wait a microphone.
Thank you.
When you compare Baidu to other Chinese companies, let's say Alibaba or anyone else, do you still see it most undervalued in China compared to the others, or is it the entire depression around Chinese stocks that creates this specific opportunity?
I think it's across the board. Alibaba is also it's extremely cheap company. I think it's just different in terms of what they do. They're not. I mean, they're competing in cloud. They're competing in AI, but Alibaba was probably more disappointment because they had a higher growth. Because what happened also 6-7 years ago, Tencent and Alibaba were growing extremely fast, while Baidu slowed significantly. That's why you saw in my chart, people kind of forgot Baidu and thought it was not interesting because it was not growing at 30% per year, per quarter, while it's only growing at 5 or 10. But nevertheless, I think no. I mean, most of Baba is also an extremely cheap company. But we think the Baidu, what's interesting is really this cash cow, the search business, which is sticky. And also out of COVID, a lot of Chinese companies want to spend more because they want to go back to business, they want to have more clients. And so you've got this, and they have a lot of cash because, I mean, they've been generating a lot of free cash flow. I mean, when you see on my chart before, you see really the markets, the stock price and the EV keep going down. So if you look at the amount of cash that what they have on the balance sheets every year is like 10% more to 15% more. And they're doing this while investing at the same time, because they're still active in many activities which are high-end and demanding in terms of R&D. So it's really an optionality on, I think, on AI. And also Taiwan, that's also quite interesting. When I talk to people, they say, I'm not investing in China. They're going to invade Taiwan. They're going to go to war. So I'd rather invest in NVIDIA and Apple. And I'm like, yeah, but you have much more Chinese risk in US stocks than in China. NVIDIA is producing 100% of their chips in Taiwan. So 100. So if the Chinese, do attack Taiwan, NVIDIA is going to 0. Apple, 85% of their production capacity is in China. 26% of their clients are in China. Apple just opened yesterday their 8th flagship store in Shanghai. So again, Apple is probably extremely at risk if Trump comes and puts 60% tax duties on Chinese goods, or if Chinese attack Taiwan. And if Chinese attack Taiwan, what? The PE of the Hang Seng will go from 5 to 4 or to 4.5, so that's a 10%. How low can it go? While I think the NASDAQ stocks can go down a lot.
So I don't know how you handle the Chinese stocks in your overall strategy. I saw that you have a product, but my question is, you can do a lot of things in this world. You can run certain risks. All depends on the size. So if you had like a 20 stock portfolio, how would you size an opportunity like Baidu?
Maybe, I would size it as an option. So probably 2-3%. Because I think there's a big optionality in the name. Either AI works and then it goes through the roof. It can be at 300 in 1 year or 2, or it doesn't. And then it's probably something that's stable cash flow as it is, like it has been doing the last 5 years. But I think it's important to keep, a lot of people are going out completely of the Chinese market. I think it's a mistake. It's too late. I see a lot of private banks in Geneva, in Switzerland, in Zurich, like Julius Baer went out of saying, no, we're not buying Chinese stocks anymore. The CIO of Lombardier 3 weeks ago, at the absolute bottom, said, we're not going to go invest in China anymore after doing the whole. And so many American investors, I hear stories about endowment funds that are even scrolling to analyze indirect Chinese exposure potentially in the stocks that they still have left. It's really, and what's interesting is many indices in China are up already like 10-15% during last month. And you have these big downward trends that might get broken soon, next week, 2 weeks. If that happens, you might have all the CTAs saying, oh gosh, here is this 4-year downtrend that's breaking, huge volumes going up, then you had the 10%, another 10%, and then price action is like changing the mind of all the investors very quickly. And then we might see people going back. We'll see, but it's a potential scenario.
Okay, thank you so much. Thank you, Alexis.